Alright, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we've got a really interesting stock to cover. And I've been looking forward to bringing this video to you guys for quite some time. So what I've been doing is I've been spending the last few weeks really diligently doing my research. And now that I'm quite confident in what I've found, I've not only initiated an opening position in Canada Goose, but I've also got a comprehensive report which I have written and this detailed video to bring to you guys. Okay, so this is going to be a really exciting episode, and yeah, I hope you guys enjoy it. If you're learning something from my videos and you're finding them useful and you're getting value out of it, I'd really appreciate it if you shared the love by hitting the like button, sharing this video with somebody else who you think might find it useful, subscribing to the channel, and leaving a comment. It really helps me grow the channel, especially when I put in sort of almost 100 hours of work researching, for example, Canada Goose to bring this video to you today. For those of you who would like a copy of the Canada 16-page report that I've written, make sure you smash that like button, get this video to 50 likes, and I'll make a copy of the report available for everybody to read. So at this point, you might be wondering, what's Canada Goose, okay, and why is it a growth stock? Now, first of all, I just wanted to quickly take you through how Canada Goose started from where they were, 60 odd years ago, 70 almost, sorry, to today, and the journey that they've taken. And this has been really, really interesting, okay? So Canada Goose, right? If you look at this picture over here, now originally it started as basically high performance outerwear that'll keep you alive in the coldest, harshest of temperatures, right? So they were saying, look, you can take this to the Arctic and you can go exploring and you'll be warm, you won't die, up to, sort of minus 30 degrees Celsius weather. You can take this trekking up the mountains, you can take this, to Antarctica, you can basically take this to the harshest, coldest places and it's going to keep you alive, right? So performance outerwear. However, fast forward till today, especially in the last 5 years, Canada Goose has actually transitioned into a luxury high street fashion brand, okay, as you can see on this picture below. And so what the company went from was, pure, I guess, blue collar type performance wear, with a purpose, to luxury performance, and it's taken a really, really interesting transition. In the last few years, they've actually shot up in ranking in terms of the sort of top 50 luxury brands from a relatively unknown brand back in sort of 2013, 2014 to, in the top 15, and we're talking about these well-known names being compared to Canada Goose, right? Your Calvin Kleins, your Michael Kors, your Gucci's, your Prada's, your Yves Saint Laurent's, the likes, and then you've got Canada Goose, right? So it's really making waves, and it's really getting up there. And what's even more interesting is that I actually think that they're sort of the innovators in the luxury space. Now, they've actually started to create stores where there's no inventory, right? So can you guys imagine that? So retail without any inventory, right? So that's luxury at its finest. And so what they're really trying to do here is to integrate this whole online, offline, experiential retail, right? Pushing the boundaries, innovators in their fields. And so what they've done is they've actually started creating different stores with no inventory, and all it has is a few different Canada Goose parkas in different sizes and an actual cold room. So the whole purpose is to get the people in, try the parkas, try the clothing, try on Canada Goose, experience it, feel it, and really just, get the feeling of what it's like to wear a Canada Goose so that they can subsequently pop online to then proceed to order it, right? So as a result, what they've done is they've invested very heavily into their direct-to-consumer channel, trying to move away from being reliant on the wholesale channel, which is very different to what all the other retailers are going through, the death of the mall, the death of the physical retail outlet, Amazon's taking over, all of that stuff. They're really, really bucking the trend. And later on in the video, we'll actually talk a little bit more about their CEO, Danny Reese. But he has been with the company since a very young age. He's been with the company, he's still with the company 20 odd years, and he was actually the one who transformed the business from about a $3 million business to about $1 billion in the space of about, sort of the 20 years that he was with the company, right? And so these are all very interesting things to keep in mind and to cover. Why does Canada Goose interest me, and what do I like about it? Well, first of all, the stock, it's down almost 50% year to date. And despite that, everything is heading up, right? If you look at the graph below, you've got, revenues increasing, margins increasing, profits increasing. Everything is increasing and it's going in the right direction. And like I mentioned before, it's still being led by the CEO, Danny Reese, who's been with the company since 1997. And he actually transformed the business from the performance brand into the luxury brand that it is today, right? So there's really a lot of things to like about this company, because from looking at the numbers and just sort of the overview, it really looks like the market sentiment towards Canada Goose is pretty negative, despite the company really outperforming. So that's sort of part of the reason why I was interested to start researching the company. And we'll cover this a little bit later in the video, but the other reason why I really like Canada Goose is because I really think that it's a brand dedicated to the new money, right? We're talking about the millennial, Gen Z, Gen Y sort of money, which will be 50% of the workforce in about 20 odd years, right? New money, it's hip, it's with the times, and obviously it's made only in Canada, right? So that's another reason, so that people who wear it, they can really get the experience and feel of quality Canadian luxury, right? So there's lots of stuff to like about Canada Goose. And we'll cover that later on in the video. So what I'll be doing, guys, is I'll be flipping through between my report and the video, because there are many things that I've written that I can't put into slides. And we'll go through the points one by one. Canada Goose is exceeding $1 billion Canadian dollars, soon to be $1 billion US dollars in terms of revenue, and they've achieved all this revenue and growth with only 19 physical retail outlets and 12 e-commerce sites. So just think about that for a second, guys, okay? All they have is 19 stores and 12 sites for e-commerce. $1 billion business. Phenomenal stuff, right? Their gross margins are very high, especially in the DTC, direct-to-consumer business, which they're actually growing significantly, and they're really targeting that as their next growth engine. And that gets you about 75% gross margins versus the wholesale of 47.5%, right? And furthermore, they're really ramping up into the non-parka product segment, right? And so what they've done is they've started releasing things like fleeces, gloves, beanies, the rest, because their brand is so strong and that it's now synonymous with, young luxury, or the young, I have money middle class. People are now starting to buy these things, a fleece, $400, beanie, sort of $100, $200, $300, pair of gloves, $200, right? So we're talking really, really high margin brand strength there, okay? So that's another reason to really like Canada Goose. Furthermore, I don't actually think the market really has an idea just how bright the future is for Canada Goose, right? And so now, this is an extract from their most recent earnings report. And as you can see here, it started off up 7%, then it went down 11%, and then it's been volatile ever since, okay? So when I see something like this, where a company has materially beat the earnings estimates and have given good guidance, but because of the situation, for example, in Hong Kong, geopolitical, very, very small part of the business, and also them not understanding the business model of the company, i.e. how the timings of their wholesale orders are, and that, month to month or year to year, the variation between delivery and recognition of revenue can vary by a few months at a time, and really that's just part of their standard business model, but has given the market a reason to sell the company off. That this really makes me furthermore interested in Canada Goose, that I think that there's just some, unjustified negative sentiment here that could make for a good re-rate, right? So guys, what we'll do now is I'm going to take you through some extracts from my report, covering what I think were the 3 key reasons why the company has gotten sold off, and why I believe that these reasons are unjustified. Okay, now the first sell-off happened when Canada Goose hit its all-time highs back last year, towards the end of last year, when the trade war was at its, I guess, most intense and the market had bottomed. Okay, so it happened to coincide at a time when the Huawei CFO was arrested in Canada. I guess you can say under the influence of the USA, sort of saying that Huawei is a Chinese spy company stealing national secrets, right? And so as a result, Canada had arrested the Huawei CFO, and the Communist Party of China absolutely lost their shit, which they then called for a nationwide boycott of any and all Canadian goods. And so that event alone caused the stock to drop 33% in December, whereas the S&P 500 only lost 9%, okay, guys? Now, this also coincided with Canada Goose opening their flagship store in China, okay? So their very first store in China along with the e-commerce site. And so the market absolutely lost their minds, and they sold the stock off, saying, oh, nobody's going to buy Canadian goods, you know, products are going to get boycotted. Any and every reason to sell the stock off, it got sold off. But in reality, this is what happened, okay? So have a look at these photos. The first two photos is Canada Goose's flagship Beijing store, and the second photo is from one of Canada Goose's flagship stores in Canada, okay? Now, there are two things to really pay attention to. You know, obviously the line is, you know, out the front door, out the street, down the street, and then round the building, round the block, okay? So that does not look like a boycott of Canadian goods. In fact, that looks like nobody really gives a shit, and they still wanted themselves a Canada Goose. Second of all, have a look at all the people. Now, obviously, all the people in the line in China are going to be in Chinese, but if you actually pay careful attention and look at the line in the flagship Canada store in I believe this was Montreal or Quebec or somewhere, have a look at all of the faces there, okay? The majority of them Asian, most likely Chinese. So what does this tell me? First of all, the anti-Canada sentiment does not exist among these shoppers, and they don't care. And second of all, you know, they couldn't care less about the government saying boycott Canada goods. They just still wanted themselves a Canada Goose, okay? So first reason why the stock got sold off, disproved, all right? Okay, let's get on to the second reason. All right, guys, so the second reason why Canada Goose got sold off was because I believe that the market's expectations of the company became way too bullish and way overinflated, which was beyond management's own expectations, okay? Now, especially considering we have a CEO that grew the business from 3 million to $1 billion, okay? He knows the business better than anyone else, okay? So whenever the market gets ahead of itself like that, it's very, very dangerous for the share price. And so as a result, in May, Canada Goose fell 25%, despite them guiding their long-term growth trajectory for the next 3 years of 20% year-on-year growth for revenue and 25% year-on-year growth for earnings at least, okay? And so now I've included an extract from a Motley Fool article, which I believe is a really good representation of the market's misguided mindset, okay? And what they said is, look, they expect this growth number, right, the 20% for the next 3 years with 25% profit. However, that's a deceleration from the 40% plus gains that it had posted in recent years. Now, the reason why that statement is incorrect is because, yes, they increased their guidance a few times during the course of sort of 2017, 2018, but that was only 3 times. And the management never, in fact, said that this was going to be the case going forward indefinitely. So they started off guiding 15% growth, and then they now bumped it up to 20% for the next 3 years at least, with 25% earnings growth, right? So never in management's time did they say, we're going to start growing at 40%. The market has wrongly assumed that they were going to do that and bid the stock up way, way, way too high. And then as a result, when their overinflated expectations weren't met, that's why the stock came down. However, the management the whole time has delivered on what they said they were going to do, right? So they never missed their earnings, only came ahead of that. All right, guys, so as you can see here on the little Excel spreadsheet extract, you can see that management started off by saying, will do 15 to 19%. They've then bumped it up to 25% for that period, and then at the beginning of 2019, at the end of fourth quarter 2018, they said, look, we're going to do 20% plus or 25% growth, earnings growth, right? And they reiterated their guidance, apart from bumping it up just for that year. And then they've gone back and said, look, we're just going to continue what we guided, okay? It's good evidence to say that management have never overinflated their expectations, nor have they overpromised, underdelivered. They've just been simply doing what they said they were going to do. So then at this point, you guys might be wondering, well, so what caused, growth to go above the management's guided numbers? Why was it so popular at that time, and what were the reasons, okay? And now I've spent a lot of time researching this, and I don't have a specific reason, but based on my research, I believe it was a combination of many, many things, right? Viral social media, social media influencers starting to buy and talk about Canada Goose, okay? Musicians starting to make music videos about a Canada Goose, talking about how the jacket, the parka, is synonymous with luxury, and that, if you roll it in dollars, then you should buy yourself a Canada Goose, okay? Canada Goose collaborating with Drake to make, the different product lines, advertising on Instagram, etc., okay? And so, with all of this building at the same time, what I think that has happened is it's created an influx of people who really, really wanted a Canada Goose at that time, which has then spiked the growth numbers up to above where it should be, but the base level still hasn't been changed, okay? And so really interestingly, what I actually did was I actually did a search about Canada Goose robberies and their largest competitor, Montclair, just to see sort of, what are people talking about when they get robbed, either wearing a Canada Goose jacket versus a Montclair jacket. And what's interesting is that two things. First of all, Montclair as a jacket is actually twice the price typically of a Canada Goose jacket, okay? So first of all, Montclair is a higher grade luxury item than the Canada Goose. Second thing is, when Canada Goose robberies happen, it happens at the person-to-person level, whereas Montclair robberies happen at the person-to-store level, okay? And so again, that's more evidence to tell me that, viral social media, word of mouth, influencers, musicians, everything, it's sort of pumped up the whole sort of Canada Goose brand to beyond what the long-term trajectory should have been, which has resulted in a temporary elevation of the growth rates, okay, guys? Now, obviously, that wasn't sustainable, but that's not to say that the long-term trajectory of 20% revenue and 25% earnings growth isn't sustainable for Canada Goose, okay? So, again, I think that the market has misunderstood and misinterpreted this information. All right, guys, reason number 3 why the stock was sold off, okay? So, now, what happened was, in the most recent earnings call, Canada Goose said, look, we outperformed our third quarter because of the timing shipments of our wholesale channel. Okay, guys, wholesale. That's bumped up this revenue by more than we expected. As a result, in the next quarter, we're expecting wholesale revenue to go backwards by about 10 to 15%, just due to the timing of the shipping and the orders, nothing more. And then it's going to go back to where it should have been in fourth quarter, and we're still going to end up where we said at the beginning of the year, which is 20% revenue and 25% earnings growth, okay? Now, the minute the market heard that, they've said, oh, no, so that's not correct. People don't like Canada Goose anymore, okay? And people, their Hong Kong store has too many problems. That's why the revenue is going to go backwards. And, it's just a fad, right? People are over it, now they want the next big thing, okay, guys? And so as a result, they've gone and sold the stock off. Now, that's about as far from the truth as it can be. And so I think that this paragraph here by the analyst John Morris at D.A. Davidson, it's a very good example of the market's misguided understanding of Canada Goose's latest quarterly reports, okay? And so they've again found the reason to wrongly sell the stock off, okay? And I've just sort of highlighted where I think the key reasons are behind the sell-off, okay? So John Morris said that the channel checks indicate the North American wholesale channel in department stores could be slowing, okay? That's the first reason. Now, the second reason is, he said, look, I've had a look at Levi's, Tapestry, and Montclair, and they all cited significant weakness from their American wholesale department store accounts on their earnings calls. And as a result, we think that the entire luxury brand goods is going to have some wholesale problems, okay? And they also said, look, Chinese consumption is going to decline, and tourism into the US and Canada is declining, and people are spending less, okay, guys? So not only is he spreading misinformation, but he hasn't even actually taken the time to research all of the companies that he's talking about, guys, okay? So let's now bust this myth and sort of give you the correct information. They've said, look, we're trying to diversify our business away from wholesale. Okay, great. So Levi's is struggling with wholesale. That's confirmed. However, their direct-to-consumer performance is very, very strong, and they're growing their US direct-to-consumer business because they're trying to do a more premium offering. Okay, guys? So keep this key information in mind. A premium offering direct to the consumer is doing very well, but wholesale is struggling, right? Okay, guys, so they don't assume any wholesale growth. So what John Morris has done is he's had a look at this and said, oh, if Levi's is struggling, Canada Goose is definitely struggling. Now, he's also mentioned two other brands, Tapestry and Montclair, okay? All right, guys, so now let's have a look at Tapestry's call, okay? First of all, they said, as Stuart Weitzman, sales were negatively affected by softer wholesale demand. They've also said, we are particularly proud of our brand's performance in North America in light of weaker mall traffic trends in both outlet and full-price retail. Kate Spade revenue declined 6%, with comps decreasing 16%, and Stuart Weitzman sales decreased 9%, reflecting softer wholesale demand. And then they've said, look, North America have been impacted now for an ongoing period, and that just forces us to be sharper with our domestic customer. How do we get better at serving the domestic customer, right? Historically, we've had many stores that were tourist-centric, and those ones are being challenged the most. So when it's a domestic customer, she more often starts her shopping during online and wants to continue that in the store channel. So how do we become more symbolic between those channels? So the reason why Tapestry is struggling is not because of the consumer spending less, but I actually think that they've significantly underinvested in their direct-to-consumer channel. And as a result, you've got all these young millennial buyers with money looking to shop online for the online-offline experience, yet they're still sort of trying to pump deeply into the retail stores. And I think that John Morris has actually misinterpreted the fact that a brand has underinvested in its DTC and online experience, and then as a result, he's misinterpreted that, saying tourist shopping has slowed down and mall traffic is dying. Now, if we look at next Montclair, which is Canada Goose's closest competitor, we'll actually see that information is not correct, okay, guys? So this is Montclair's earnings call. Wholesale also performed well, in line with management indications of high single-digit growth, okay? Driven by good acceptance of the fall-winter collections. Wholesale results were particularly good in US and Japan. The North American market was good in both channels, particularly in wholesale. In the wholesale and its big players, which are department stores, we keep doing well with all the names, okay, guys? As you can see over here, once we've compared Levi's, Tapestry, and Montclair, Montclair being Canada Goose's most close competitor, we can actually see that John Morris has misinterpreted the two brands for underinvesting in their DTC business and having weak performance as overall weak market performance, which is just clearly not the case, okay? The department stores which are stocking luxury brands are doing well, as long as they're being smart, savvy, and engaging their consumers, okay? The ones that aren't doing well aren't engaging their consumers, okay? And so as you can see, I mean, if you think about a luxury department store, okay, think about Nordstrom, okay, somebody who would stock, Levi's and Montclair and Canada Goose and Kate Spade and Stuart Weitzman, right? Why would Montclair be doing well and then these other brands not doing well if there was a decline in mall traffic? It's obviously not the case, okay, guys. It's more so a case of execution on on Levi's and Tapestry's part, rather than the entire industry, and also Canada Goose's timing of its shipping affecting its wholesale business, leading to a decline the next quarter. All right, guys, and at this point you might be wondering, well, okay, that's cool, but management said on their earnings call that Hong Kong has some problems, and that's a good reason to sell the stock off. Well, again, that's not a good reason, because the Chinese and Hong Kong market is a very, very new market. Okay, it's still in its infancy. Okay, now, yes, the Hong Kong market would have been a problem for Canada Goose, but I don't actually think the impact would have been that much. Okay, guys, because if you look at Montclair's earnings call, okay, even they had problems in Hong Kong. They said we lost about 40%, which is a big number, but this is reality, and they don't see the numbers improving, okay? But then if you now have a look at Canada Goose's Asia numbers, okay, $26 million in fiscal quarter 2 2019 to $48.9 million, okay? And now this was with all the problems going in Hong Kong at the moment, and they've almost doubled their Asia business, okay? And that was largely driven by the Chinese consumers in China buying. So if you guys think about this, again, it's really not a big deal, okay? I don't actually think Hong Kong would have contributed any more than about 1.5% revenue towards the overall number. So again, the sell-off has been overdone. All right, guys, so at this point you might be thinking, okay, that's cool. So obviously the John Morris from D.A. Davidson analyst guy is wrong. Canada Goose is doing well, Montclair's doing well, the Chinese shoppers are still loving it, they're still buying lots of stuff. So what does management think about all of this, okay, guys? And now there's a lot of text, so we're not going to sort of go through each and every bit in detail, but what I just wanted to do is I wanted to highlight a few really important paragraphs just to show that management is doing what they say they are, and they're executing on what they're promising, okay, guys? So, first of all, the non-Parker revenue nearly doubled, rising to a third of channel sales. This is very important because this transitions Canada Goose from a Parker luxury brand to a holistic luxury brand that'll sell no matter what season it is, not just in the winter season, okay? Canada Goose's stuff is never marked down and almost always sold at full price, okay? Second of all, the direct-to-consumer channel has now increased to more than 50% of their overall revenue. This gives me really good confidence that the direct-to-consumer channel will continue growing exponentially and eventually lift the margins up to, much, much higher than what they are today, which is 47.5% gross margins. Okay, guys, next comment from management. The wholesale channel operates largely as a planned economy. Our fall and winter spring order books are set down to the color, style, and/or well in advance, and this gives us great visibility throughout the year. Okay, guys? So what this tells me is that the orders are known well in advance, right? If they ship it earlier, they already knew that. If they ship it later, they already knew that. They know how many orders to how many customers, and there's a lot of visibility. So again, this is just another reason that the whole quarter 3 wholesale is going to go backwards due to shipping timing and the market not believing management. Obviously, that's an overreaction, okay? The lineups at our stores, we get, again, people camping out overnight to get some of our collaborations and to make sure they get one of them, okay, guys? And, don't just take management's word for it. You saw the line of the photo at, their Beijing store, their Canada store, their flagship store, okay, guys? Again, really good evidence that management is executing and the brand is strong. There is no excess inventory risk. It's not risky inventory. It's inventory that will be sold at full price, and it's inventory that has been available for many years, okay? It's been like that for the last 20 years, going back 20 years. None of that stops our wholesale partners coming back and asking for more, but you'll also recall that we operate at an allocation level. The allocation model privileges our in-stores first and then our e-commerce, and then we consider how we replenish wholesale orders when it makes sense to do so. And guys, I think that's probably the most important paragraph that we'll cover here out of all these paragraphs, okay? Now, if we read that a few times, what we can infer is that management have the stock to continue shipping the wholesale numbers so that quarter three, doesn't go backwards. However, they're purposely not doing that because they're saving the inventory for the direct-to-consumer orders, especially around things like, all of the different seasons, right? We've got Singles Day, Black Friday, Cyber Monday, Christmas, Chinese New Year's, all of these key seasons landing during the core cold months, okay? And what I think Canada Goose has done is going, no, actually, we'll just keep our stock and we'll sell it for 75% gross margin rather than 47.5%, okay, guys? And like I said, this is a very important paragraph, which again shows management's savviness, the understanding of the business model, and the fact that they have things under control. All right, guys, and at this point you might be wondering, well, look, what if management's talking shit? What if they're trying to, not keep the share price from falling over? So what I'm going to do next is I'm going to take you through some specific evidence which actually supports the fact that everything management have said above is true, and that everything is going well for the company. All right, guys? Screenshot number 1. This was taken on the 16th of November 2019 from Canada Goose's official Chinese Weibo page. And they had 98,500 followers, thereabouts. A little bit later, just a couple of hours later, and then they had about 104,000, okay? Now, the next screenshot I took was 24 hours later on the 17th of November, and they had 107,546 followers, okay? So that's an increase of 1,228 followers in the space of 24 hours. Now, that's pretty good, right? But that's not all, okay? Now, what I did was I took a screenshot earlier on this week from their official Weibo page, and as you guys can see over here, 120,604 followers, okay, guys? So 1 week later, they've grown 20-something thousand followers, and if you now follow the link and then keep on tracking, you'll just see it's going up and up and up like this on a day-to-day basis, okay, guys? And that really gives me confidence, a lot of confidence in their Chinese business. But you guys may be wondering, okay, well, that's just one segment. What about the rest of the world, okay? How do we track that? And so what I would suggest you guys to do, and I've done all of the tracking in my report, but, obviously that was a few weeks ago, so you should sort of continue tracking, is use some of the sites, okay? And some of the sites that I use to track things like followers, engagements, brand recognition, all of that, you've got the following, okay? So we've got SimilarWeb, okay? We've got web traffic, statistics, visits, backlinks, how long they stay, the clicks, what they click, who referred them, okay? Very, very useful. SEMrush, again, a very, very good tool to track web traffic, search traffic, engagement, brand engagement, all of the above, okay, guys? And obviously, your Google Analytics, okay, guys? This tool is, it's invaluable, okay? Canada Goose started off as the incumbent to Montclair, and over time, if you look at the blue line, you'll actually see that they've started to eclipse Montclair. And not only that, but if you have a look, right? The highs are higher each and every time, year on year, okay? And now the yellow line is the north face, okay, guys? But again, we can only loosely draw a comparison because obviously there's not going to be as many people who can afford Canada Goose as the north face because Canada Goose and Montclair, they're all, proper luxury brands, right? But it's really, really interesting to notice that in each and every single region, you'll see that the Canada Goose analytics for Google, right? Its engagement on Google, YouTube, all of the platforms, it's going up in a straight line that way, but also the peaks are higher at each peak, okay? And this is very similar for most countries apart from, I think it's Sweden or Norway. So what does this mean and what does this tell me? Well, the answer is very simple, guys, okay? What it tells me is that engagement is going up year on year, and the number of people visiting their websites are increasing, right? Which will increase the number of orders because of the DTC. The interest is increasing, right? The trends. So what this tells me is that not only is it increasing, but it's also sustainable because we don't see any massive drops, right? Because if you have a fad, it goes like this and it goes down, okay? But obviously that's not the case. And so what that does is it reinforces to me that this brand is here to stay, and people are engaged, and they will continue to be engaged. And I don't see any reason, for the foreseeable future that they won't be engaged, okay? And just to conclude about the engagement of web traffic, as you can see over here, Hong Kong, its web traffic has effectively tripled when they launched their flagship stores. Okay, so despite all of the violence and all of the problems going on with Hong Kong at the moment, you'll see, wow, it's still tripled. Awesome. Imagine what's going to happen if when all these Hong Kong geopolitical problems cease, right? So again, very, very encouraging reasons to buy and hold the stock. And again, I just wanted to take you through an extract from Nordstrom's most recent earnings call. You can see that they've actually raised their end-of-year guidance on their third quarter call because of their outperformance in luxury brands like, Canada Goose, Louis Vuitton, Valentino, and the likes of Nike. Okay, guys. Now, this obviously is good news for Canada Goose, but it actually annoyed me a little bit because, see, fucking Nordstrom, they reported their numbers the day before I finished writing my report on Canada Goose, and as a result, they went up, and then after the weekend, they went up some more. Okay, guys. But having said this, what I've done is I've initiated a small opening position of 1,500, and my plan is to double this position depending on how things go. So I do hope the company dips a little bit so I can double my position. But like I mentioned, I haven't put my full order in because, like I said, it's already gone up about 12% from when I wanted to buy. So I do hope that it does pull back down to sort of the $34 mark. If not, and it remains around these price levels, I'll probably just buy it the second half of my position the day before the next earnings call, which is on the 12th of February next year. All right, guys. So at this point, you might be wondering, okay, cool. Well, that's a reason to buy Canada Goose, but what's Canada Goose worth, and what's going to cause it to go back up? Okay. Now, I've got a couple of price targets for Canada Goose. The first price target is the short-term price target, which is $45 to $48. Okay. And how I came to the conclusion for this price target is because, as you can see, technically it looks oversold on a short-term downtrend. It's sort of at the key support levels, okay, guys? And so what I believe is going to be the catalyst is them continuing to deliver on this 20% revenue growth and 25% EPS growth, okay? And they're going to, and the catalyst is either going to be on the next earnings call, which is the fiscal quarter 3 earnings call, or the one after that, the fiscal quarter 4 earnings call, okay? Because at the moment, the market doesn't believe that it'll continue to grow at 20% revenues and 25% earnings, and they've sold the stock off. Now, once management proves them wrong, then as you guys will know, it'll probably cause a re-rate towards the next sort of short-term resistance, which I believe is the $45 to $48 mark. Okay, guys, now for my longer-term holders out there, you can say, well, look, what if I'm not in it for the short run? What if I'm in it for the long run? Like, what's a good medium-term intrinsic fair valuation? And the answer to that question, it's a little bit tricky, but what I've done is I've taken a few sources to try and help narrow down the medium-term fair valuation. And the first source is Montclair, which is Canada Goose's closest competitor, okay, guys? And as you can see over here, they've grown their revenue at a compounded annual growth rate of 24% from 2003, and they currently trade at about a PE ratio of about 27 to 30. That's sort of the average PE ratio. But what's important to note is that more recently, Montclair's earnings growth has actually, I guess, slowed down to about the mid-teens. And the other important thing to remember is that Montclair, now they get 69% of their revenues from DTC and only 31% from Canada Goose versus, from wholesale versus Canada Goose's current about 50% revenues from DTC and 50% from wholesale, okay? Now, the reason why this is important is because this means that as Canada Goose continues to grow their DTC, we can expect their earnings and margins to increase. Therefore, their earnings growth might actually be even more than 25%. And the other reason why this is important is because Moncler is about a €1.5 billion business, okay, and they've managed to successfully grow it at a compounded annual growth rate of 24%. Now, Canada Goose today is only about a 1 billion Canadian dollar business. So if we convert that to euros, if we convert Moncler's 1.5 billion euros to Canadian dollars, you'll see that it's roughly 2.2 times the size of Canada Goose's business, okay, guys? So this will help us project where I believe Canada Goose's revenue is going to be in the coming years, considering now it's sort of eclipsed Moncler in terms of the Google trends, okay? So we can see that the number of searches and the engagement on Canada Goose's brand is actually even more than Moncler, which gives me confidence that it can maintain its 20-odd% revenue growth and 25% EPS growth. So based on that, if we apply a net margin of 22.76%, which is Moncler's net margin today, to Canada Goose at 2.2 billion Canadian dollars, you'll realize that we come to sort of a net profit of about 500 million Canadian dollars, okay? Now, given that Canada Goose's share count has been relatively stable over the years, so to be conservative, guys, I've applied a share count to calculate the PE ratio of 130 million, which is significantly more than the current 110 million today, guys, okay? So that's almost a margin of safety of about 17%, okay? Now, if we apply a PE ratio of what Moncler is currently trading at, which is about 27 to 30, and we apply that to a Canada Goose's 2.2 billion Canadian dollar business at a net margin of about 22.7%, which comes to an earnings per share of 3.84 Canadian dollars. Converted that to US dollars, we come to a US dollars of 2.89 US dollars earnings per share, okay? So if we multiply that by the PE ratio that Moncler is trading at today, we actually come to a medium-term share price, of about between 75 to 80, almost $90, okay, if Canada Goose continues growing at the rate they do. And based on the research that I presented to you today, I don't have any reason to doubt that they won't grow at this rate, okay? So that's my medium-term fair valuation. All right, guys, so now that we've covered the key points, and we know that Canada Goose's future is bright, their management have things under control, that we now know what the fair value short-term and medium long-term is. I've just got a few final concluding comments about Canada Goose to take you through, and then that'll be the end of the video, okay, guys? Okay, so first comment, okay? Now, I've spent a lot of time speaking with people that I know who have family in China, okay? And I encourage you, if you want to do some more research about Canada Goose, is to speak with people who have family in China, especially Gen Y, Gen Z, and millennials, okay? Especially in the cities in the north of China, like Beijing and more north, which get cold, okay? Ask them about Canada Goose. Ask them about, what people are thinking about the brand, how they're engaging with it, etc. Because my research tells me that the minute they ship the goods in, it's sold out within weeks, okay? Okay. Second thing, for my viewers who are sort of your deep value investors, guys, okay? This stock is by no means cheap, right? If you have a look at some of these ratios, okay? Now, these ratios are absolutely eye-watering, okay, if you have a look at it. But I think that, they're more than justified if we think about everything that we've covered in this video till now. And for all those of my viewers who say, oh, it's too expensive, or, it's overpriced, what I have to say to you, my viewers, is good shit ain't cheap, and cheap shit ain't good, okay? And guys, and in terms of if you guys are saying, look, it's a bit of a growth stock and it's really high risk, buying it now, who knows if it's going to deliver on what the management have said, okay? If you're still not convinced after looking at all of this sort of evidence that I've shown you, now I just wanted to sort of draw a similarity between this and another growth stock that I hold, okay, which is the A2 Milk Company. And from my research, I see so many similarities between the A2 Milk Company and Canada Goose which again makes me feel that there's going to be a very bright future ahead for Canada Goose, right? I bought A2 milk around about here at the end of October, before their annual general meeting call, because again the market has said, look, growth has slowed. They've got competitors, all the wrong reasons why they sold it off. Okay, and so what happened? Okay, as soon as the call happened, the share price went up 15 to 20%, and as you guys can see here, I bought my parcel on that day because I was confident that based on my research that the market have got things wrong based on fundamental evidence, all right? And as a result, come time for the annual general meeting, 19th of November, share price surges, China's doing great, lots of China sales, China can't get enough of it, margins are improving, brand recognition is growing, it's the sort of number 2 stock it's the number 2 product on Alibaba Tmall in China, okay guys? So again, very, very sort of similar story between how A2 milk was sold off in Canada Goose, which again gives me confidence holding and buying, all right? And finally, guys, if you just have a look at the sort of short interest in Canada Goose, 27.36%, okay? And again, I quite like this, and the reason being is because it makes for a really good sort of jump up in shares when the shorts cover, when they realize that the story is actually not broken and not fallen over. All right, guys, so that concludes our video on Canada Goose today. I know it's a bit of a long video, but I've put a lot of love and sweat and research into this, and I'm very comfortable to bring this video to you to sort of share what I found. Okay, now guys, again, just remember, like all of my videos, none of this is financial advice. I'm not a qualified financial professional, so you should always do your own research and speak to a professional before you buy or invest in anything. But guys, look, I really hope you enjoyed the video, and would love to hear your comments and your thoughts. And until next time, happy investing.